The following is a conversation with Amadeo Brands. He's the co-founder and CEO of Yieldnest, a protocol who pushes the boundaries of what's possible in the liquid risk-taking and automated DeFi strategies. But actually, more importantly, Amadeo is someone who's seen the entire arc of crypto evolution. From working at one of the first crypto hedge funds in Netherlands going through the ICO boom, DeFi summer, and now he's actively contributing to maybe the most dangerous and most promising phase yet of DeFi, and that's finalization of everything. He's a token engineer who thinks about incentive designs, the way a physical things and fundamental force says seek elegant solutions to complex coordination problem. In this conversation, we will explore the nature of value, trust, and human coordination in programmable money systems. We discuss why sustainable yield might be the DeFi's hardest unsolved problem, whether we are building, liberating, or enslaving financial infrastructure, and what happens when code doesn't just represent money, it literally becomes money. Amadeo, was quite happy to have you here.
Likewise. Thank you so much for this amazing intro. That was fantastic. And yes, as you said, the most dangerous time in DeFi, I would say, yeah, kind of true. And also the most exciting time, of course, right? So there's a lot of things happening currently. And thank you for that intro. I've been in DeFi for a long time, since it was still called open finance. That's kind of how it started, right? Like open finance, kind of first saw MakerDAO and the CDP model. I remember when I saw that first, it's like, oh, okay, we have a way to use our assets, borrow against it, and then what do we do next? Well, there was not that much to do next. You could just borrow against your ETH. That was it, right? But you could kind of lever it up. So that was cool. So I was doing that when the market was going down. So then you lose money. But luckily, I also did it when the market was going up as well. So both sides. And we're still doing that, right? And actually with Altoscope, we're very happy to work together with you guys on different Euler vaults that we're deploying. And that's basically also extending that DeFi primitive. We're all connected by simply math and code right now. And I think it's very important for the world to have a way to say no, right? So diving right into it, I would say DeFi for me is important because I think it's important for the world to have a path that if the regulations come in, that people can just say, no, I just want to do things on chain. And that's also what I'm working on with Yieldnest right now. We're building, vaults, completely transparent, high risk adjusted return. I built a completely new vault architecture from the ground up after working with different protocols, learning a lot of different things. And I kind of made my own design. We're boosting forward, and the DeFi structured products are going to come on chain. Yield is going to come on chain, and it's going to be very exciting.
Thank you. We met from the first days of Yieldnest. I remember when you closed your first financing round, we came to contact, and luckily the collaboration out of it emerged. But maybe to start off, like you were one of those rare people who were from the beginning of crypto in the space. You have been working, as I understand, in a hedge fund in Netherlands. Saw the ICO boom, which I mentioned, the DeFi summer. And now you're kind of working again in this risk-taking, and we have this modularization of DeFi going on. So basically, you are an OG by the definition. What kind of pattern everyone's missing about those cycles and how they actually work? Because when we look the last 10, 15 years, it was Bitcoin, it was then ICO, it was DeFi summer, risk-taking. Now we have some kind of DeFi 2.0. Is there some kind of pattern you're seeing or emerging from your experience so far?
Yeah, I would say it's finding a better foundation in overall finance. And like indeed from the beginning, we had I first got into crypto in 2011 by just, having Bitcoin and not just kind of nerding around with that. Then I was working on Ethereum, and like actually back then we already started with like, hey, we want to make on-chain rules happen, right? So that you don't have to construct a lot of different bureaucratic layers, but just have one top layer and then structure different logic with smart contracts. I got really attracted by that because I was working as a software engineer at a bank in the Netherlands and doing mortgage insurances for the Dutch mortgage markets. And I was structuring these products and maintaining their like IT systems. And I saw like most of this stuff can be replaced by smart contracts. So then I got excited, and I found it back then a little bit too early. So the ICO boom was really cool for me with Cyber Capital. We did make a crazy return of around 11,000% gains, right? And from 2016 to around 2018, that was a really crazy time. And we're already diving really deep into the fundamental research of these products. But back then it was really simple. Basically what I did, I wrote a script and I was going to all the GitHub repos of all these new products. And I was actually looking who was actually producing code. And I was using that to have an investment strategy, right? So we started with around $500,000 and we grew to like 80, $90 million, $70, $80 million AUM at that time. But then also the bear market was really harsh, right? So we actually back then already thought like, maybe we're gonna continue. This is a revolution, etc. It's a little bit harder. So that was my first like big cycle. In 2013, I already experienced a cycle, right? Like, but we went like it was lower. It was not that much attention. In 2017, it was very much attention, and then it just exploded because there was not that much else to do on chain. And then we kind of moved on, and then suddenly MakerDAO kind of survived, Aave survived, and then we had DeFi Summer. That was very exciting, a little bit inflated by FTX.
Yeah.
Yeah, and now we're entering this space. Yeah, I would say I'm very bullish, but I think it's gonna blow up at some levels, right? You see a lot of the DeFi vaults that we're building now do not have all the on-chain accounting, right? Like we are, it's really hard to build smart contracts. It's like building financial logic in assembly language sometimes, right? So it's not
But there are now many
easy,
questions
especially.
which pops into my mind. So basically, you mentioned 2011 you came to crypto. Just out of curiosity, like entering crypto or dealing with Bitcoin 2011, it's like in today's world, like people see you as a genius, but back then you had to be like kind of crazy. What was the conviction you had? Like, was it the technology? Was it the ideological view? Or what attracted you to Bitcoin? Because back then it was just nerds using Bitcoin.
Well, as we all are extremely brainwashed by our schooling system, it's like kind of like getting out of that and kind of learning what money is, right? Being like, oh, what is this money stuff? Oh, I can buy like digital credit cards and Silk Road, it's also actually a thing, right? So, oh, you can buy drugs online now with this anonymous cryptocurrency called Bitcoin. That was really cool. So I saw that. And then I also saw a way to get it. It was very interesting. Some of my friends that were even earlier than me, you could only get it by actually traveling to a guy that was mining it, right? So in the beginning, going to mine it and Mt. Gox, etc. Luckily didn't lose anything there, but I was also, not buying that much at the time. I was just a student, so I just got a little bit via a friend of mine, and I just kind of forgot about it. And then in 2012, 2013, it shot up to 1,000, and then it was a lot, right? And then I just just did stuff with
But
it.
was there any
even
kind of ideological view, or you just liked the idea of technology, Bitcoin speculation, and you wanted to be part of it? Because
I was learning. For me, what clicked for me was I studied computer science and economics. So for me, I was interested in economics and computer science. So I was like, oh, wow, this is really cool. So the white paper I almost read on like day one. The difference I think with the community now is that when you entered back then, it was more of a technical thing where people are sharing papers and was like, hey, look at this. Like it was a bit different. So it was definitely more like, oh, what is this thing with all the cyberpunk manifesto and those kind of pathways of the internet that you then get to, right? Like when you start to dive deep. That kind of got me excited in 2012, 2013, when I was really kind of understanding it, right? So that's also when I wrote my first blog about Bitcoin. I don't know if it's still live, but it was on my personal blog at the time. That I thought like Bitcoin is the first one, but it's going to be many more. And I always was like very excited about immutability and programmability of a decentralized ledger. Basically, write once, read many, right? You want to, yeah. That I was always very excited about that aspect of it, and I think that's
I
gonna
understand.
really change the world in many ways and be the democratess, right? The sort of democratess is like we're transparent, but you're also transparent.
And we are going in this direction, like to be honest, and you were right, like many, like the industry changed like since Bitcoin. I mean, Bitcoin has a very clear position now and it's unstoppable, how it's going to evolve. And then Ethereum came out, you were very active there. So you mentioned that you were part of this, like I can call it also like investment vehicle into tokens. So basically first of those liquid funds which ever existed. And Amadeus, I also know you're part of the Llama risk team, right? So basically, still your financial background, which you had back then, mortgages and so on, didn't disappear. You entered into this space by analyzing and learning about the risk, right? And you're still active there.
Yeah, that really started as a more of a hobby. I was still CTO for another like company. I was just doing some freelance work there, and then I was besides that doing a lot of work for DAOs. Back in the day, I actually made the best decisions I made in DeFi was always the self-altruistic things. Like I gave a course in DeFi with Ivan on Tech, which around 70,000 people did back in 2019,
Wow.
where I was kind of teaching, develop how to learn how to learn Web3, right? So you have Web2, and I was giving a course about flash loans and these different things, how you would implement that and use that. And surprisingly enough, already in 2017, it was really hard to make money with flash loans. Obviously, if you hack something, you can make money with flash loans. But with just arbitrage, but it's a really interesting software primitive that we can now have like these atomic transactions. And yeah, I think the world doesn't fully understand that yet, that we can have these atomic agreements between each other. If you look at the mortgage market, for example, as I said, right, the refinancing and the way that the velocity moves of mortgages or of private credit, if we can bring that on chain, that's going to be very exciting. But it's going to be a little bit of a battle of the centuries. How are the worlds going to collide? I think that is the long summary of where we are. How will the TradFi and DeFi worlds collide? And I think it's going to happen. And I'm one of the 100 monkeys that is never going to implement any KYC AML in my software. Like that goes against my religion. So it's really important for me.
But it's very interesting, like to see, like you're saying now we are in this convergence of TradFi and DeFi. It feels for me like it's happened. Like we are over this threshold. When we look what's happening at the moment in the United States, we can criticize and we can prize there, but nevertheless, like we have this stablecoin act. They are going in this direction. It feels like an acceleration, which I personally didn't expect is going to happen that soon. And this gives a lot of space now for those innovators in DeFi space from the early stage, like Yieldnest, for example, to extend in something from risk taking where you started into something more advanced, more beautiful, and so on. But also there is a critique which you can put out, and this is basically when you look at the new DeFi protocols coming out, and I believe you publicly wrote about that somewhere, that DeFi is more or less on a tech point of view, copy paste of existing projects. And on the other side, most of those protocols, the successful are some kind of forks of previous version. Is the innovation level in crypto a little bit overrated and it's all about something else?
It's a very good question. Yeah, I think before, if you would build something new, you would actually be rewarded by the market. Right now, people just don't give a shit. They kind of just want to see a token, a protocol doing something, and token go up, right? These are two different skill sets. So in order to build new software or to think about new primitives, you have to think differently. I do think like when I see, for example, what Michael Agrov just built with Bybases or Resupply, there's still a lot of many actually protocols that also develop new components, right? But unfortunately, what we see with the meme coins and other things, a lot of the money in the system is flowing to these really weird things, where actually before it was flowing more into, well, I guess with the ICO boom, we also had a bunch of scams and weird shit, right? But I think percentage-wise, well, I don't know. I guess it's improving now, but especially before, you would not get rewarded for building good code. But I think that's changing. But yeah, the same thing happened to Yieldnest as well. We had our TGE went very bad. The reason actually is I've also purposely want to delist from MEXC. I think one of the biggest cancers right now in our industry is basically centralized exchanges. And it seems that and it's really hard as a builder, and I experienced that myself, to actually choose to launch in DeFi because it's much more risky and etc. And your investors do not want you to do that, right? They're all pushing you to all these centralized exchanges, which I tried, with Binance, etc. But it's a very cutthroat, not nice angle of our industry, I would say. And if we can actually build these things more on chain, transparent, here you go, this is the protocol, this is the revenue, blah, blah, blah. And we're doing that now, right? So we started with chasing all these exchange stuff, and because everybody's doing that, so like, okay, I fell for that myself as well, and I feel bad about that because I should have just launched on chain. But it's difficult because you have market makers and investors that actually advise you otherwise. So I think it's really bad in the space now. It's really hard to get funding. It's not easy. And then you get a lot of pressure to do certain things, like go to decentralized exchanges, because then it's easier for the investors to exit. Actually, it's much better. Just launch on chain, everything transparent, bang, directly do it. And I wish I would have done that from the get-go, because we could have easily done that, but we try to aim very high for these centralized exchanges, and that kind of makes all these projects, annoying. Even the projects that I know that were quote unquote successful, they still have a lot of stress. It's hard to innovate when you have your token now with all these centralized exchange drama that you have to deal with, right? So yeah. But luckily, we see a way forward. We're just going to build our liquidity on chain now, and we're going to continue like that. I see a good pathway there. But what I would have wished is that I would have done that from the get-go. But that's fine. Yeah.
Yes, I kind of feel you. Like, to be honest, like we are at Alterscope a little bit down the line of the curve of launching a token. But it's, as you said, it's a very, very different game. It's not rewarding actually the innovation. You talk with the centralized exchanges, and it's not about centralized exchanges that are bad. It's just huge amount of money you need. If you want to succeed there, it really matters where you're launching to get the liquidity. Then they have their own terms, and not only that they are screwing up your project on a tokenomics side with their requests, they are requesting huge amount of money in upfront, so basically taking from the project. And this is done in a cycle where you have to do huge fundraising rounds to make this working, but this money doesn't go in the development, doesn't go in the community building, it goes into something else. And then in essence, the market is all about this liquid enablement of exiting the one who put early money into the space. And it's a skill set which requires very strong marketing capabilities with partnerships on this kind of stuff. And it's very, very unfair. So basically, everything what we were hoping in DeFi is not going to be. It's kind of, we are entering into this, I don't know how to call it. Like, it's a chaos at the moment. It's chaos. And we need something to change that, or the perception of the user has to change. He should be like more sophisticated using decentralized primitives. This is one option. Is this realistic? I'm not sure. And the other option is basically, I don't like the word similar as you, even like thinking about regulation, because this centralized side is not working at the moment. Nevertheless, like you touched that you launched a TGE, and maybe to touch a little bit this point. So basically, you launch a protocol which is called Yieldnest. Yieldnest provides 10 to 15% yield on top. Can you give the audience maybe a rough or high level pitch how this yield is coming together and what is exactly Yieldnest doing, for example, compared to Aave?
Exactly, right. So DeFi is always very interesting. And especially being in DeFi for such a long time, I always get a lot of questions, and I want to get more people into DeFi. And it's really hard for people to use multiple protocols, right? And to rebalance against it and to know what's safe and what's not. So the way as it started, and restaking is an element of that, DeFi is an element of that, kind of the way it was a DeFi structured product platform that kind of started 2.5, 3 years ago, more as like, oh, I want to make this into this components that I can open source or build vault architectures for myself and see if I can structure my own investments or other people's investments that people want me to manage in those kind of structures. After also important, I worked with Cyber Capital, and then I also worked with DeFi Capital, another DeFi hedge fund that I also grew from basically a small amount to around 800-900% yields, and that we run that cycle. And I was always like, I want to bring that on chain, those kind of structured products with durations and with different yield sources, right? And I have a lot of experience with that on the management side, right? When DeFi was still maturing. And now DeFi is mature, we can build these structures on chain. And that's kind of how it started. And restaking was always one of the elements that I find exciting because, like we can structure DeFi in the way that we're doing a circle jerk where we only take DeFi components. But we should ideally mix and match different components with each other and also have other outsized yield sources and then combine these components together, right? That I was really excited. I'm still excited about that. But these things need to be verifiable on chain, right? And that's why I like restaking, because now we can actually verify off-chain components, bring them on chain and actually use them in a verifiable manner and then merge these two worlds even closer together. And I saw that also as a little step. And what I did, I started with that, and I actually built now a whole new stack. So it started as just a restaking aggregation protocol, as then of like, hey, wait a minute, we can see a path forward where we can design a whole new vault architecture that we can use to deploy these vaults and components.
And this is also important for the audience to understand. Yieldnest is doing in the background really a lot of things which are not really visible. For example, when we take a protocol like Euler, Morph, or Aave, all of them are providing a yield. Some of them are also providing the yield from risk taking, and it feels like, okay, they are all same, but it's not true. In the background, how the guarantees are coming together on the yield side, how the risk assessment is done, and how the composability altogether works, especially on more advanced financial products, really matters. Now the question is like, Amadeo, who is our audience at the moment? Are these DEGENs, or are these like very sophisticated traders who have a lot of capital, who made money over the last 10, 15 years, and now they're deploying? How do you feel like that, what you are building? Who cares about this differentiation, to put it this way?
Question. I think the most important thing is that we just get more people on chain. And I would say it's people that are DEGENs that are trading. And we can actually see a lot of these different components, right? That people that are trading, they also need a place to park the money safely, right? So this could be institutional investors or retail alike. And I think in DeFi, there is no, like, everybody talks about institutional investors, blah, blah, blah. But in DeFi, there's code and everybody should be able to interact with it, right? So it's useful for people that want to have some money laying around and just poof, shoot it into one of our max vaults, like it automatically rebalance and to get you high risk adjusted returns without doing anything too crazy, right? Like always making sure that we monitor all the code and all the oracles and all the components, and we also monitor underlying protocols that we work with, obviously. And then you can decide yourself, right? Like YNETH is basically a liquid staking derivative. So it's our own LSD. And then you have YNETH, which combines our own LSD with other components, and also goes a little bit off chain. Yieldnest basically helps you aggregate and is at one point into DeFi where you can get a token that's easy to have and automatically rebalances over protocols like Curve, Frax, and all these other components that are might not that known by everyone. And it combines it and it also moves it around between different assets. So our new stablecoin product works with FX protocol and Super USD, and it rebalances over both. And if anything goes wrong, it withdraws can withdraw very quick from that position, and you will have less exposure. If you're fully exposed to one of them, you have more risk, right? So you need to think about that. If you spread your exposure, there's less risk. So in theory, it's a better return, right? There's a higher risk.
But who is your audience? Who do you targeting with it? I understand. So basically what you're saying on one side is DEGENs. They don't have to deal with Frax and other protocols. Or are those people like whales who understand the space quite well and they want to get last squeeze from the yield on their capital? Who is
The
like,
nice thing
I
is that
will
you
say,
can
of course,
vote,
both of
right?
them, but who is the first target?
I would say there's two targets. There's one target that is the DEGENs, because we do give a playground for DEGENs. If they want, they can lever up the token, as you saw in the Alterscope vault. We do create different scenarios, right, in this vault. So when there's junior and senior tranching in traditional finance. So that's also similar how our vaults work. But right now we only have the one layer live, right? But soon we're going to split that up, and then you will get like more interest from both sides. So you can actually make a very secure product, and you can make a riskier product. And I would say it's a multi-sided market, and you actually, to be successful as a yield aggregator, you need to, or as a liquid token in DeFi, you kind of need to bring those two sides together and make a happy marriage in the risk parameters that you're trying to trade with them, right? So I think we give both the exposure. For example, Wine RWAX, we also have a product where we're going to basically invest in secure private credit to Australian real estate, which is not managed. We are not the issuer of that. We are just the vault. We are the vault architecture that creates the technology enabled to that issuer to actually issue those kind of credits on chain. We started around 50 to 100 mil of collateral in Australia that we can then use in DeFi. And that people then can borrow. Like you see there's collateral and you can borrow out USD, and if it doesn't come back, you can liquidate the mortgages, right? So it's a really cool new mechanism, and we can design it in a way that we have kind of not seen it before. And I think it's also a little bit of the Binance moment where, if you are a little bit more on the we're just trying to structure it in the best way possible and give as much access to as much people as possible, right? You saw the same thing with the Binance strategy when centralized exchanges came up, right? I think something similar is going to happen in DeFi, where you basically get all these new RWA assets and they're all going to try to gatekeep it, but that's not going to work. You need that open and secure, right? You cannot have it behind the KYC wall, basically.
You mentioned now also, like, this is getting very interesting. You mentioned RWAs, real estate, tokenization coming on chain and so on. I mean, Amadeo, I don't have to tell you too much about on chain risk. We are both in the space. There is a lot of complexity there with interconnectedness, cascading, and so on. You have to deal with. But now a new component coming up into the space, and it's credit risk, off-chain credit risk. How are you dealing with that? I mean, in the end, you are offering a product to the end user, and credit risk has to be done by you. Even you can rely on services for. In the end,
Yieldnest is not offering a product, right? Like Yieldnest is offering a vault architecture, and another issuer is using our architecture to deploy a vault, and we
so risk creator, kind of.
Yeah, they are the risk creator. Like we are just, it's the same thing as like, I mean, Morpho is offering Alterscope a vault, but it's not so that Morpho is like responsible if Alterscope would make a parameter mistake, right? It's not that somebody can go to Morpho and say, guys, whatever, what the fuck's going on, right?
That's true. Yeah, that's I agree with you. But how do you see that with the credit risk now coming into the space? I mean, we both witnessed 2021, 2022, how Terra unveiled, how FTX happened. Now we are bringing even more complexity in. We have more DeFi protocols, more ecosystems, and now we're having credit risks. How do you see, and like what's also extremely important to mention here, we didn't touch this point at all, everything is extremely leveraged in the space at the moment. Everyone's doing looping. We have these derivatives ongoing. So basically the risk compounding is happening in real time here. And how do you see this going to play out from here?
Yeah, I am worried sometimes about that because like I think it's gonna blow up at some point, inevitably, right? Like similar as it did before. We can see that what happened to FTX is just gonna happen again in our industry, unfortunately. People need to learn that there's on-chain, there's certain things that you can transparently see on-chain, right? And there's certain things not. So for example, with our RWA vaults, you can always actually see how much instant liquidity is available. And if that runs out, you can actually see, okay, what is the collateral? Okay, there's still that collateral. And then, that is going to be pretty dangerous, especially if there's not good like disclosures and et cetera, from these different sites of a product. But it's a dilemma because you cannot disclose everything. So I think what needs to happen is that we're actually looking into that. There's Chainlink and other protocols are working on these like ZK proving systems where we do need to prove the collateral that's backing it, right? So in this case, the private credit deals that we're doing, I'm traveling to Sydney on Sunday to inspect some things there, to talk to lawyers, etc. And then you can have provable collateral that you can showcase like, hey, this collateral is actually a mortgage where you actually have a caveat and a claim on if that action doesn't happen on chain, right? So we are able to do that. And we're actually also able to do that with Borgs, right? Borgs are new organizational types developed by Aragon. And if we all remember the Borg from Star Trek, right? And it's like this unstoppable AI mechanism. Well, it's the same thing as that. Like we can build on-chain organization wrappers that just do very simple actions, right? You could like prepay lawyers and say, if repayment of mortgage doesn't happen, then activate legal firm XYZ to then liquidate mortgage XYZ, right? And that infrastructure is there, but the question is like, will that then settle on this immutable ledger? Will that be accepted, or are we going to get resistance, right? I think we're at the stage that we're now getting a lot of leeway, and at some point something will go wrong, and then a lot of resistance will come, and I think that is kind of inevitable in this cycle. So the only thing we can do is, for yourself as a user of DeFi, is always try to do that research and see like, okay, what is the risk, right? So for example, Wine ETH X, we're not looping. We're just going into Wine ETH and Repsig ETH. That's why also now, like when Repsig ETH, the raw queue kind of extends, you can see our vault kind of has to wind that down, right? So then the yield goes a bit lower and it will be higher again. What I'm worried about is that some of these other protocols, they just keep on paying higher yields. So it's like, how do you do that, right? Like it's possible, but you always go up the risk curve. And we choose not to do that and stick to our principles there. But also we could make mistakes, right? So there's always a risk in anything you do on chain. There's always going to be a risk. And the much that we can do is try to make that provable. Try to make these things as much atomic as possible so that you can actually stack trace completely down the stack from A to B what's actually going to happen. Same thing with Bitcoin or ETH, like you can stack trace it. similar financial products. Well, that's very difficult. So then we go back to building financial systems in assembly language. That's also not what we want. So we need to find the middle ground. And I think now with the new hook systems, we also implemented that in the Yieldnest vaults. Basically, all our vaults have hooks. So similar to what Uniswap V4 has. That's also what we have implemented now. And we're experimenting with that, but that's very new, right? You saw what happened to Bunny the other day, and other hooks are very new. We actually also found a bug in one of the templates for hooks from Uniswap. Well, it was an open source template, so it's not an official one. But yeah, we found a bug in there, but it was something that was pretty much used. So we did report that, but nothing super major, but still something that needed to be fixed. It's very early on that front. So what's important for all of us to work on that together. Because I think in general, if that doesn't happen on an open source way, it's going to have issues anyway, right? So you will get a lot of hacks anyway if you don't open source that stuff, right?
Of course. I mean, open source in theory is like working quite well. Everyone is auditing, contributing, and so on. But often incentives are missing to do that, and people are not aware of that. And then we have teams who are basically contributing for the collective good hereby. But here is also an interesting point. I mean, we are now introducing many of these single point of failures, and the whole idea of blockchain was actually to distribute that to minimize the risk on that side. This is obviously not really possible, or it's going to be some kind of hybrid solution there. And some things are not controllable at the moment. We have to invent new ways how to deal with that. What I'm more interested is you have a lot of experience evaluating DeFi protocols from previous cycles, and you saw everything in this space. What is, in your opinion, or how you see the most relevant signal for DeFi protocols and teams who are going to survive the next bear market? I mean, we are now in this bull, of course, speculation going on, but at one point, again, we will end up in some kind of bear market. What do you see as the most important thing, or what you're looking for as an indicator of survivorship in a long run in this space?
Yeah, it's difficult, right? Like DeFi protocols are very risky to run, so it's a lot of work. And I think it's important to have that culture fit, like try to do the good thing and try to build systems and components that other people can inspect. And we try to push the space forward in general. So I would say people that try to be somewhat self-altruistic in the sense of like, hey, for example, Yieldnest did also a big airdrop, although the token price down and everybody's pissed about. We did do an airdrop, right? Like, and try to really bring back and try to make these things transparent. And I think it's very important. We try our best, right? As best as possible, but it's really, really difficult because there's so much so much stress and things around a lot of different of these components. But we did choose to work with Aragon and the DAO system, and we're implementing that. Yeah, and I think the DeFi protocols that do have a roadmap to like, hey, we do want to become more decentralized and we do want to go there. Yeah, that's what we need to look for. But it's not a sexy thing, right? It's not. The problem is with that, it doesn't pump the token, but it does harden the protocol. So it's a difficult thing, because if you focus completely on, hey, look, we're completely decentralized. Yeah, people will be like, oh, where's my yield, right? So it's yeah, but that completely decentralized, like Lido, like USD, USD, or other completely decentralized systems are becoming attractive in the bear market, right? So they see that's like happening. It's bad because the cycle should be the other way around, but it's kind of always like that, I guess, right? So I would say projects that are actually focusing on decentralization, not just talking, but actually proving things, are definitely something to watch for. And then looking into the GitHub, like if you look at our GitHub, we have a lot of stars, we have a lot of forks. Our Vault architecture is being viewed a lot by different people. So I always look at GitHubs of protocols and see if they're actually still committing code. That's really important to inspect. And then I make decisions of interacting with the protocol, seeing how the flows go. And it's also important that how are the contracts structured, or time lock, or they don't even care about, a lot of protocols nowadays don't even care about time locks anymore. So like you need to look into that. Like those things are very important, I think. And it's like kind of hygienics to do it, in my opinion. So I would look for that. Those
But
things.
that's very, very interesting. So basically, if I hear you out, you are really looking at the fundamentals of the project. Are they really caring on the development of the project, decent code writing? Are there activity going on around the development? But I mean, let's be honest here in this space. A lot of in this space happening through money. And some projects are very, very good on fundraising, very, very good on token launches, and they manage to get huge amount of capital. And this gives them space to do, if they are not rugged, let's say like this, enough space to find or acquire what they need at one point to do that. And when I look some kind of Dino projects from 2017, that's exactly the case. Huge amount of capital, and now they're slowly building and building and building. They're not disappearing. How do you see that?
Yeah, I'm more bullish on that, right? So I'm more bullish on Curve or on other like Aerodrome, Velodrome. They're still building, right? Like, I mean, these projects that are around for some time, Aave. I mean, if you want to be safe, that's where you need to go, right? Yeah, it's as simple as that. Like, I mean, they had the luck that they had a good, successful token launch, but even projects, as long as they don't get hacked, like I look at how long is a code base online and how much money is it securing, and I calculate that. Like I look at like, oh, a code base is live for 1 year and it secures $100 million, right? So then it's $100 million secure, for example, right? And if it's secure
Kind
a
of
billion
a
or
Lindy
a
effect.
month, right? You can make, yeah.
So you're looking in a Lindy effect, okay. And how do you fit then basically Yieldnest in the first sense is a risk-taking protocol, and risk-taking in itself introduces rehypothecation, it introduces additional risk. How do you see risk-taking in general? Does it make any sense for you? Because these AWSs, we don't see it at the moment.
No, I think it was a complete failure in the sense of that actually Eigenlayer and Symbiotic both didn't really deliver in time. They're now actually doing some really cool stuff again. So it takes more time, right? Like it was kind of clear. They kind of oversold a little bit, but there is something there, right? So what Eigenlayer built with shared security models or Symbiotic is fantastic and it is valuable. But it needs a little bit more work and understanding and SDKs and education for people how to use that infrastructure or how to use decentralized ledgers in general. And it seemed there was a bit more interest. It seemed to have a bit more code, so we could actually go to work with it, go to insurance companies, go to other components. But we kind of, from the Yieldnest perspective, we kind of had to build it ourselves, right? So we had to build ourselves now the different strategies with co-processors that we're implementing, looking into implementing with Bravis or other components in order to make that work. But it actually originally was like, yeah, well, Eigenlayer can fulfill that, but it didn't really do that. So we had to pivot, but we're also still maintaining our stack there, right? So we have our restaking stack. So basically we have our stack where we do, restaking to Eigenlayer at the moment, but we can easily expand that also to other platforms. Eigenlayer kernel, we also do on BNB chain. And like Symbiotic, we also have an implementation for, but right now we're not doing that because there's no real yield, right? But that is now coming with projects like Cap Finance, which I'm very bullish on. But there we have real risk. That's the problem. Nobody wants to take real risk. So it's impossible, but everybody's taking so much risk, but no one wants to take risk. So what you then get is this really weird thing of people thinking they're not taking risk, but they're actually taking a lot of risk. And that needs to stop in our industry. I also don't know how to do that. I'm trying my best with making all our vaults completely verifiable on chain and inspecting that, although we're also not perfect, right? We have a lot of work to do there, but our code is open source, so we're trying to contribute and see how we can solve this. And I think that's what we need to do as an industry.
Makes sense. We will see how this risk-taking will play out. I really hope it will get traction with more mature and decent AWSs. Why is for me this interesting actually? Because once this AWS is coming in and we are moving away from LRT projects as a focus, then real new sources of yield are coming in on a fundamental level. They are doing something, and you have this shared security, which is fundamentally working. And we are not like, I mean, don't get me wrong, like LRTs are amazing. They managed to get staking on chain, bringing a huge amount of liquidity to DeFi, actually fostering speculation and not just for doing like this staking. Even there was like already ongoing elements like Lido risk taking just did build a new, like let's say a new level of something like that. And now if we had risk taking, this was kind of the narrative of the last year. Now in this year, or let's say like second half of the year, the second one was DeFi combined with AI. A lot of AI protocols coming together. All of them are doing asset management, rebalancing, running strategies. On a data side, how do you see that involving now? Is someone who understands the risks quite well, because this introduces a lot of additional things which people don't understand. How do you see this AI vertical now evolving?
Yeah, that definitely needs more experimentation and time, especially on the self-execution side. What we're now building, we're getting a bit distracted with the TGE, but we have Nest AI out, right? And we made our own ELISA model there to kind of mostly experiment and learn. right? And what we want to build, and I think what we will also see more in the industry, is these kind of DeFi agents that will do even crypto transactions for you, but you still have to kind of sign off by yourself, right? Because like having an AI doing things fully automated is difficult, but having an AI collecting a lot of information, reserving you with certain data, that's definitely possible, I think.
Understand. And I mean, I'm really kind of bullish on the DeFi AI side because it feels it could solve the problem. Actually, actually for me, the most like something which people don't really see is that DeFi AI in combination with AI solves the problem that you don't have to interact with many protocols. If you do it quite well, it could be like one place you enter and then you can run very advanced financial products if done quite well with multiple of protocols on different verticals and get a very decent outcome. And which basically means that a normal DGen could basically get exposure to whole DeFi and not only one protocol he's interacting, and he doesn't have to manage multiple of ecosystems and this kind of stuff. But it's, as you said, it's early. It's way too early, and we will have to see how this is going to play out. So now we went to multiple of these 90% dot rounds. So basically, you know how this crypto goes: overconfidence, and then really depression point where you basically from all-time high are something like 90% down in losses. And you are someone who went through multiple of those cycles. You saw the best, as you mentioned, like your fund before had 11,000% returns. But then on the other side, you went through a bear market. How do you manage this mentally, emotionally, these bear markets?
Yeah, it was really hard, right? Especially in 2017, because we're still exploring a lot of the different use cases for cryptos. It's like, oh, what? Yeah, we have this ledger stuff. Nobody cares anymore. What are we gonna do? I would say, yeah. And the problem with the newer cycles is I think if you buy a meme coin and you get completely wrecked, yeah, what can you do? I don't know. Cry in a corner. If you get wrecked on some sort of a protocol, whatever, you can understand what happened or what went wrong. Even actually, if you get wrecked on a meme coin, kind of understand why did you get wrecked? What happened? Or the market just went down, or what happened, right? Like, oh, how can we improve this? Learn from it and see how you can do it better, or what you can contribute to not make that happen.
But how do you
Something like
manage
that.
that emotionally? I mean, it's not easy. Like it's very easy
No,
to see the chart, it recovers, but once you see the losses and what you had before, it's not easy mentally to manage this.
yeah, but always take a little bit of profit, right? So I always recommend to at least take your original investment out at some point, right? So that's what I did myself. I went in big at some point and I just took it out. At some point, it's let the rest slide, right? And that gives so much more security. Actually, if you are too scared of losing everything, you should probably just sell 20-30% just to just feel better. And if you don't, yeah, then yeah, you should not go all into crypto, although I did that a couple of times in my life as well. But actually not what you do, I think. But I was just so convicted. Yeah, it's a hard thing, right? Because actually if you're younger, so like if you're like 18 or 25, 30. I'm now 37, but if I would just be 30 or 25, yeah, you can go all in into things. If it goes wrong, you just go back to work and you maybe do it again, or you just keep working, right? But if you're older, yeah, you have to watch out. But in general, yeah, life is about taking risks, but don't go all in too much, I would say. Always try to make sure that you either have the earning capabilities or the, yeah, enough capital, right?
And what do you believe we are now entering in? Do you feel we are going into bull run, altcoin rally, or do you feel like it's still some kind of in-between phase? How do you feel this phase evolving over the next 6 months to 1 year?
I think we're gonna see another banana zone. So I think we're actually, yeah, we're risky, blah blah, right? But if you worked in traditional finance, you know that it's although it's all secured credit or it's all, but it's even more levered up there, right? And that's also the crazy thing. Some of these DeFi things are happening are more crazy and all transparent with how they loop things. But also in traditional finance, there's a lot of risk going on. And once the two worlds converge between the treasury rates and the DeFi rates, and we see that with Athena and other protocols, it's kind of hard in itself. So I think we're at a hardening phase, but I think we're going to go into this bubble zone where things will unfortunately probably go too high at some point, and then be sure to cash out. But it could extend over in January, February, March. You don't know, right? How long it goes on. I think, yeah, October, November, December are generally better months. I think September is going to be a bit choppy, but afterwards there is a
But do you
there is
believe
a
the
banana zone
interest rate will
possibility.
play a role?
ruled out.
Do you believe the interest rate could now play interest rates from United States, the Fed decisions in the coming months could play a pivotal role for the DeFi speculation to unwind it? Or do you see it as a just ongoing thing which is already priced in the space?
Yeah, at the end of the day, it's just a criminal organization, the Federal Reserve or any fiat system, right? But I think that basically, yeah, they lower the interest rates, the crypto risk assets will pump. But we're not sure if they're going to do that, but they kind of have to, right? So it's like, if they don't do it, like, yeah, it's a hard decision, right? I would say with a long-term horizon, like 5 to 10 years, it's going to be fine. In the short term, sell when we get on our peak and sell a little bit, or at least feel comfortable, right? I would say, but I think we're going to see more banana zone top, but then rotate into more stable positions as well in DeFi and stay there. Disconnect yourself from TradFi and stay in DeFi because it is possible, but don't go for the 50, 60% because you will lose money. Like if you just go for more modest yields, you can survive.
So a lot of it's a lot of learning by doing, experience and so on. You're growing also emotionally there. Dale, thank you for your time here. I will wish you success on Yieldnest side. I really know what is happening around the protocol. I see the future here. I see like fundamentals built around the protocol. And I hope that over the next coming months and years, Yieldnest will manage to get into one of the leading DeFi protocols in the space and reduce this amount of harm we had so far in the space, because I personally believe you are one of those few handful protocols who are actually taking risks quite seriously.
Yeah, correct. But also we have a long way to go and to prove ourselves, and we're definitely going to do that. It's very exciting and very exciting times, and I'm very happy to be part of this together with Altomscope and Yieldnest. Exciting times. Time to move forward, and yeah, it was a pleasure talking to you, and hope to see you soon.
Thank you, Amadeus. See you in one of the upcoming conferences.